1,900 million euros, 1.9 billion. It's a number so large it's almost abstract. For years, this money sat on the balance sheet of a company called Wirecard, Germany's proud technology champion. It was proof that Europe could build a fintech giant to rival Silicon Valley. There was just one problem. The money wasn't real. It had never existed. This isn't just the story of a corporate collapse. It's the story of a national delusion. A story of how regulators, auditors, and an entire country's political establishment were so desperate for a hero that they ignored the warnings, attacked the truth-tellers, and became cheerleaders for one of the biggest financial frauds in modern history. This is the story of Wirecard, and the 1.9 billion euros that was never there. Like many early payment processors, Wirecard started in the murky corners of the internet. Founded in 1999 near Munich, it made its name processing payments for online gambling and pornography sites, high-risk, high-fee businesses that traditional banks wouldn't touch. But under the leadership of its enigmatic Austrian CEO, Markus Braun, who joined in 2002, Wirecard had grander ambitions. Braun, a former KPMG consultant with a signature black turtleneck, sold a vision of a global payments powerhouse. He was calm, intellectual, and spoke in complex jargon that made the company seem sophisticated and futuristic. For years, the growth was staggering. Wirecard expanded across Asia, buying up small local payment companies. It acquired a banking license, allowing it to issue its own credit cards. It promised investors a revolution in digital payments, a seamless flow of money across the globe. And Germany, a country dominated by industrial giants like Siemens and Volkswagen, was desperate to believe. Here finally was a tech company, a fintech unicorn that could compete on the world stage. The media celebrated it. Politicians championed it. In 2018, in a moment of supreme national pride, Wirecard replaced the centuries-old Commerzbank in Germany's prestigious DAX stock market index. Its valuation soared to over 24 billion euros, more than Deutsche Bank, the nation's flagship lender. Wirecard was no longer just a company. It was a symbol of German innovation, a national champion. And when you're a national champion, your critics aren't just skeptics, they're enemies. But not everyone was buying the story. For years, a small group of short sellers and journalists had been raising red flags. The loudest and most persistent voice belonged to Dan McCrum, an investigative reporter at the Financial Times. Starting in 2015, McCrum began publishing a series of articles questioning Wirecard's accounting. The numbers, he argued, just didn't add up. The company's profits seemed impossibly high. Its acquisitions in Asia were opaque and wildly overpriced. He pointed to a 340 million euro deal for an Indian payments company, whose founders had valued its key assets at just 46 million euros a few months prior. Wirecard's response was not to clarify its accounting, it was to attack. The company accused McCrum and the FT of market manipulation, of colluding with short sellers to drive down the stock price. They hired aggressive law firms and PR agencies to discredit the reporting, and the German establishment circled the wagons. Instead of investigating Wirecard, Germany's financial regulator, BaFin, did something extraordinary. It launched a criminal investigation into the journalists. This is where the story turns from a simple corporate scandal into a systemic failure. In February 2019, After the FT published a detailed exposé based on a whistleblower's documents from inside Wirecard's Singapore office, the company's stock price tumbled. BaFin's reaction was swift and shocking. It announced a complete ban on short-selling Wirecard stock for 2 months, an unprecedented move to protect a single company. It was a clear signal. The German state stood with its national champion. The regulator, whose job was to police the market, had become the company's bodyguard. Behind the scenes, it was even darker. Wirecard went on the offensive. The company hired former Libyan intelligence chief Rami El-Obeidi to conduct covert surveillance operations against journalists and investors. Private investigators tailed reporters. Hacking attempts were made. It was a campaign of intimidation designed to silence anyone who dared to question the official story. Think about this for a moment. A publicly traded company, a member of Germany's top stock index, was using spies to target journalists. And the country's own financial regulator was providing cover, treating the truth-tellers as the criminals. So how did they do it? How did they fake billions of dollars in revenue and profit for years, right under the noses of one of the world's top auditors, Ernst & Young? The answer lies in a deliberately opaque system of so-called third-party acquirers, or TPAs. Wirecard claimed that in certain markets where it didn't have a license, it used these external partners to process payments. These partners would collect the money from customers, take a small fee, and then pass the rest on to Wirecard. By 2018, Wirecard claimed that these 3 phantom partners in Dubai, Singapore, and the Philippines were generating almost all of its profits. Here was the genius of the fraud. Wirecard told its auditors, EY, that the vast majority of its profits were being held in cash in trustee accounts managed by these partners. For years, EY auditors never independently verified that this cash actually existed. They relied on screenshots, forged documents, and confirmations from a trustee who was part of the conspiracy. It was a house of cards, the revenue was fake, the profits were fake, and most importantly, the 1.9 billion euros in cash, the bedrock of the company's balance sheet, was a ghost. By 2020, the pressure was unbearable. Under fire from the FT and skeptical investors, Wirecard had hired KPMG for a special audit. The report, published in April, was a bombshell. KPMG could not verify the existence of the cash. It found a black hole at the heart of the company. Still, Wirecard and its CEO, Markus Braun, insisted everything was fine. The money was simply being moved between banks. But the clock was ticking. The company was legally required to publish its audited 2019 financial results. The day of reckoning came on June 18, 2020. Wirecard announced that its auditor, EY, could not confirm the location of 1.9 billion euros in cash. The company's stock began a freefall from which it would never recover. For a few frantic days, the company maintained the charade. Braun claimed Wirecard was the victim of a massive fraud, but the truth was closing in. The Central Bank of the Philippines announced that the documents claiming the money was there were fraudulent. The money had never entered their financial system. On June 22nd, Wirecard finally admitted the truth. In a short, stunning statement, the company said that the missing 1.9 billion euros likely did not exist. The collapse was immediate and total. On June 23rd, Markus Braun, the visionary CEO, turned himself into the police. He was arrested on charges of fraud and market manipulation. But the company's charismatic and mysterious chief operating officer, Jan Marsalek, had vanished. Marsalek was the operational mastermind of the fraud, a man who cultivated connections with spies and shadowy figures across the globe. While Braun played the part of the respectable tech CEO, Marsalek managed the dark machinery of the fraud. He chartered a private jet from Austria, told colleagues he was going to the Philippines to find the missing money, and then disappeared. Investigations later revealed he had fled to Belarus and then on to Moscow, where he is believed to be living under the protection of Russian intelligence services. The man at the center of Germany's biggest financial fraud was a suspected Russian asset. On June 25, 2020, Wirecard, once worth 24 billion euros, filed for insolvency. It was the first ever DAX company to go bankrupt. In the aftermath, the blame game began. Markus Braun, now on trial in Munich, claims he knew nothing of the fraud. He paints himself as a victim, betrayed by a rogue COO, Jan Marsalek, who he claims was a sole mastermind. But prosecutors allege that Braun was the head of a criminal gang that had been systematically looting the company for years. They argue the fraud was not a secret operation run by Marsalek, but the very core of Wirecard's business model from the beginning. Meanwhile, the auditors, Ernst & Young, face a barrage of lawsuits from investors who lost everything. For over a decade, EY had signed off on Wirecard's accounts without ever independently confirming that the single largest asset on its balance sheet actually existed. They accepted screenshots and forged documents as proof of billions in cash. But the biggest failure lies with the German state itself. The regulator, BaFin, saw its job not as a skeptical referee, but as a cheerleader for a national champion. It ignored credible warnings from the world's leading financial newspaper. It actively pursued the journalists telling the truth while allowing the criminals to operate with impunity. It was a catastrophic failure of oversight, driven by a mix of incompetence, arrogance, and national pride. The Wirecard scandal serves as a chilling sequel to the story of FTX. In both cases, a charismatic founder sold a futuristic vision. In both cases, billions of dollars in customer funds turned out to be phantom money. And in both cases, regulators were asleep at the wheel, dazzled by the promise of innovation. It reveals a dangerous truth about our modern economy. When the narrative is compelling enough, when the promise of national glory is bright enough, we can convince ourselves to believe in anything, even a 1.9 billion euro hole in reality.